Hello everyone and welcome back to Magno Investments. Due to the current geopolitical conflicts and political changes, stock markets are facing several drawdowns and the worldwide economy is struggling. Many investors have seen their portfolios down during these months. The idea of a high inflation or even a recession has made the valuation of the companies fluctuate. Today we are going to analyze the actual macroeconomic situation in order to understand and anticipate the different scenarios. Before continuing, bear in mind that all I say in this video is my personal opinion, and the following information is for an educational and divulgational purpose. It should never be considered as an investment advice or investment recommendation. I have summarized the main existing catalysts that could possibly enhance and boost the European economy. The first one I would say that is the European growth and recovery. Generally speaking, Europe had never had the same growth and market return in comparison with the USA. However, we have to consider that there were occasions where the US stock market was likely not to perform well in many years. We can see how after the 2000 dot-com bubble, the S&P ended up almost at the same level after 10 years. During the last years, there has been a general negativity in European stocks that actually has been promoted by the regulations that Europe was implementing and the low economic growth that it was experimenting. That combined with the excellent USA market returns made the institutional and the retail investors look beyond the sea. This feeling has been increased by the new president of the USA, Donald Trump, who threatened and imposed tariff and taxes of many of the foreign products that USA imports. Being Europe one of the main suppliers, the effect was immediately noticed in the European stocks. The major companies affected by this trend were especially the European small caps, which, as you probably know, are more exposed to the interest rates and economic downturns. On the other hand, and at the same time, small caps are more dynamic in order to adapt to the real economy. Through history, small caps have generated higher returns than other kinds of companies. Moreover, small caps tend to be less covered by professionals and institutional investors, so those amongst investors with an edge can find bargains easily. The second reason to look at European stocks will be the USA stock market valuation. As we can see, the current S&P PE ratio valuation is above its average. That will not be a problem if the valuations were reasonable adjusted to the EPS of the companies, and the weight of the index were properly distributed among those companies list. However, what market calls as the Seven Magnificent reach almost the 31% of all index value. That implies a huge concentration in a few stocks, which as said, its high PE ratio makes it complicated to think that the relationship between risk and profit remains the same. As a proof of this, here we can see how Nvidia stock in some point became larger than the respective stock markets of Germany, France and the UK. All of these combined with a weaker dollar and the deterioration of the economic and geopolitical decisions of the administration has produced a highly volatile investment climate that presents a substantial risk of loss, but also a fertile field of opportunities for many active, informed investors prepared to seek profits across markets and different asset classes. Actually, we can see how during these weeks a huge amount of capital flowed by the USA market to European stocks. There are other factors supporting this potential shift. Other is the relative valuation. The sharp rise in the USA market, primarily boosted by the recent EA expectations over the last year, has made it more expensive compared with Europe. Monetary policy has also played an important role. While the Federal Reserve has held back expectations of aggressive rate cuts to the extreme of the USA economy, the European Central Bank has maintained a soft attitude about it, which has favored European markets. Another aspect to mention is the geopolitical conflicts and their implications in the stock market. The possibility of ending the conflict in Ukraine will have a tremendous positive impact of those predictions, since the end of this situation is not discounted in the real economy. Removing international sanctions and embargoes will improve international business and trade. Energy costs, lack of raw materials, and many logistic implications made inflation rise to these years all over the world, especially in Europe. Ending the conflict would not only benefit the countries involved, but also the companies that have been affected and compromised in a direct or indirect way. As a conclusion, I would say that doing nothing and trying to predict the next stock market crash or the exact moment when market valuation is lower is an error. If we look back through history, these problems happen in a very similar way. What we can expect from the current situation is nothing more special what people were expecting in the last economic crisis or the last market correction. Well, so where should be invested or what we can do to protect our capital? What we can do is stick to our personal strategy. No matter if inflation rises or even if we face a deflationary scenario, you should be prepared for every possible change, so you will be able to adapt and take profit for every possible situation. Personally, I think that we should be aware of global changes, but if we have a very well diversified portfolio and we really know what we are investing, we will be able to navigate this situation without major problems. Well, I hope you have enjoyed the content and see you in the next video. May the investment be with you.